Hi class, on today's lesson we'll be looking at chapter 4, problem 2b. You should be able to see problem 4 or chapter 4, problem 2b. And what we're going to be doing today is we're going to be reviewing with you how to prepare financial statements and closing entries. You'll remember in this chapter, we're learning how to journalize closing entries, post the closing entries to the ledger, and prepare a final trial balance. But in this problem, they're just going to go over financial statements and closing entries with you again. So this is really kind of a review of what we did the last time that we met. But the more you hear it, I think the better off you'll be. So they've started this company, which is going to be Gorman Company, and it is a financial planning services firm, and it's operated by Nicole Gorman. And as of October 31st, 2019, the end of the fiscal year, the accountant for the Gorman Group prepared an end of period spreadsheet, part of which follows. And this is your adjusted trial balance. And you'll remember the last time that we talked about the spreadsheet being a tool that you could use to help you to prepare financial statements. But it's an optional tool. You have to prepare an adjusted trial balance at the end of the accounting period. So you can just use the adjusted trial balance to prepare your financial statements. Today, we're going to be preparing the income statement, the statement of owner's equity, and the balance sheet for this Gorman group. And the first financial statement that we always prepare is our income statement. And the income statement is prepared for a period of time because what we want to do is we want to measure all of the revenues that we've accumulated for this period of time and match them against the expenses that we have for this period of time. And the income statement will tell us whether or not we have net income or a net loss. And in this situation, all I did is I copied from above my revenue accounts, put the balances in there, and added them together to find the total revenue. I copied the balances from my adjusted trial balance that were expense accounts, and I put the balances in, and then I added all my expenses together. On the income statement, you're going to compare your expenses with your revenues. If your revenues are larger than your expenses in total, that will give you net income. And this is the case here. Remember, net income is useful to us because it shows that our owner's equity is increasing. Net income will add to our owner's equity. So the next statement that we need to prepare is the statement of owner's equity. And the statement of owner's equity, again, is prepared for a period of time. We're going to start from the beginning of that period of time and go all the way to the end of the period of time and collect everything that's happened to the owner that would affect the owner's worth in the business. So the statement of owner's equity, in this case, is going to be prepared for a whole year. The beginning of the year started in November 1st, and ended up at October 31st, the end of the year. So we're going to start with the beginning capital amount for Nicole Gorman. And in this case, this amount is given, and it was copied from the adjusted trial balance. So we'll scroll back up here and let you see the adjusted trial balance. And the adjusted trial balance amount of $220,000. That's where I get that beginning balance. If there were additional investments that this owner had made, it would go on the next line before the net income that we're showing here. In this problem, there were no additional investments during this month, so they just left it out. And so what we will have is net income for this period of time. The net income comes from the income statement. It's just copied in. And then the owner's withdrawals, which was given in the adjusted trial balance in the drawing account right here, is copied into for the withdrawals. The $20,000 amount is just brought forward from those given amounts. Now, the net income is a positive amount, which will add to owner's equity. The withdrawals is a negative amount that will affect owner's equity. And so we're going to combine the two of these together. And because my positive net income is more than my withdrawals, I have an increase in my owner's equity. So my owner's equity is going to increase by $93,000 during this period of time because we had net income that positively affects owner's equity, and the owner took out of the business $20,000, which would negatively affect his owner's equity. These two are combined to get $93,000. Once you know the increase in owner's equity, since it's an increase, you're going to add it to the beginning capital balance, and the ending capital balance, or the ending amount that that owner is worth in this business, is $313,000. The next financial statement that we're going to prepare is the balance sheet. And notice on the balance sheet heading, the balance sheet is prepared for 1 day and 1 day only. It's a picture, the balance sheet is a picture of the company's financial position or condition as of June 30th. That shouldn't be June, that should be October 31st. So let me change that date there. So just bear with me here while I get it changed. Okay, that's better. This is for October that we're preparing this financial statement for, and it's for 1 day because it's a balance sheet. Balance sheets are only prepared for 1 day, 1 point in time, which is at the end of the accounting period. Notice this balance sheet, I broke it down, the assets down into current assets and property, plant, and equipment. This is what we call a classified balance sheet because the assets have been broken down into current assets and property, plant, and equipment, which are your fixed assets or your plant assets that could also have gone in as a title here. You're going to list all your current assets, and those are the assets that we intend to convert to cash, or they are assets that we intend to use up within a year. So accounts receivable, we're expecting to convert to cash within a year, and our prepaid accounts, we're expecting to use up within a year. And so that's why we classify those as current assets. The current assets were just brought down from the adjusted trial balance amounts. You just copy them down here. And then we're going to total our current assets to get $55,000 in this case. For your property, plant, and equipment, we always list land first, and land is recorded at its cost always. There's no accumulated depreciation that goes with land. We discussed that in chapter 3. We just record the cost of the land. However, if we are a depreciable asset, such as buildings, we will have to put with the buildings account. The building account always goes in at the cost, but we'll have to put the accumulated depreciation account that goes with that building underneath it. The accumulated depreciation account will offset the cost of the building, and that will give you the book value of that building. So 250,000 minus 117,200 will leave you with the book value for the building at 132,800. The book value is just a title that we put as far as what we've got on our books, that the equipment is it's just a book value. That's the only thing I can tell you about it. This is called book value. So your equipment would be recorded at its cost less the accumulated depreciation. The book value of the equipment is 88,300. You're going to combine your land, your book value of your building, and your book value of your equipment. All of these go together to get your total plant assets. Once you have your total plant assets, add your current assets to that, and that will give you the total assets. Your liabilities on the balance sheet for a classified type of balance sheet are also broken down into current liabilities and long-term liabilities. This company had only current liabilities. Current liabilities are those liabilities that you can pay off within a year. So again, I just wrote down all my liabilities, copied them from the adjusted trial balance. That's where you get the amounts. And then you're going to total them up to get your total current liabilities. The last thing that you're going to put on a balance sheet is the owner's capital at the end of the year. And that only can come from your statement of owner's equity. So we'll refer back to our statement of owner's equity. The 313,000 is where you get the amount that goes here, which combined with your liabilities gives you a total liabilities and owner's equity amount of 351,100. Notice that the total liabilities and owner's equity has to balance with the total of the assets. The balance sheet is a restatement of the accounting equation. Assets are listed on the left side of the accounting equation, and then your liabilities and your owner's equity are combined so that the right side of the accounting equation balances out. In part 2 of this problem, they're asking us to journalize the closing entries. And you'll remember that we said that closing entries consist of temporary accounts that are closed at the end of the period. Our temporary accounts are going to be all of our revenue accounts, our expense accounts, and our drawing accounts. When we close them, we're forcing the accounts to equal 0. So what I've done is I've listed a whole lot of T accounts here that represent your revenue accounts and your expense accounts and your drawing accounts. Your revenues, your expenses, and your drawing are going to be closed out. You might notice down here in the corner, I have capital account. Capital is a permanent account and it is never closed out. So you're not going to close out capital, but you're going to close out the rest of these accounts. And to do that, what I did is I just copied in the adjusted trial balance amounts for each one of these accounts. Or another thing you might notice, if you're closing out all your revenues and expenses, you're really closing out all of your income statement accounts. So you can get this amount from the income statement too. But this is the starting balance that has to be closed. To close out an account, you would simply do the opposite of whatever the balance is in that account. So revenue has normal credit balance. To close it, we would debit it. We're going to debit it for the same amount that is in the credit side as our balance. And when we do that, it's going to reduce the balance in this account to 0. To close out our rent revenue, we do the same thing. We debit the $5,000 to get it to a 0 balance. we're going to also close out our expenses. And to close the expenses, you do the opposite of the increase side, which is the credit side. To close out your accounts, you put the same amount on the credit side, and you're just forcing these accounts to equal zero. So we're going to do that for each one of our expense accounts. We're just crediting each one of our expense accounts to close them out. This is sort of like a cleanup procedure. And you close out all of your revenues and your expense accounts. And so what we would do is we would prepare a journal entry to show that we are closing our revenue and our expense accounts out. So it's this huge compound entry that we're doing. And so your fees earned was debited. So up here, I put in debit to close it. I closed out my revenue on the debit side. And you never ever close capital. But what happens when you find the difference between revenues and expenses? Your difference is 113,000. So here's your income statement. This is your difference, which is net income. And you'll remember that we said that net income adds to our capital. So what we had to do is we have to credit the capital for 113, which is for our net income. And so I wanted to label that for you so you'd have it, a copy of this when you, are looking at it separately, if you decide to look at your spreadsheet separately. But I'm going to post this spreadsheet like I always do. So you'll have this so you can look at it. But the net income is going to add to the owner's capital account. And that's why we credit the capital here for 113,000. This 113,000 is the amount of the net income. And so what we're doing is we're closing out our revenue accounts by debiting the revenue accounts to get rid of those revenue accounts. And then we credit each one of our expense accounts. And because there was net income, our capital is going to be credited. But capital is never ever closed, but all these expense accounts are closed, and so is our revenue. And so all I did is copy down the credits to all my expense accounts from the T accounts that I had up here. And this is how you make the first closing entry. The second closing entry will be to reduce the drawing account to zero. So what I'm going to do here is I'm going to put in the drawing account. I'm going to close it, and I got to close it for $20,000. That'll reduce it to zero, and I will debit my capital account because drawing will decrease the owner's equity. So this capital account is really a reflection of the statement of owner's equity that we just prepared. So the second journal entry is going to be made for the amount of the drawing. So these are your closing entries. These are your cleaning up of your accounts. Now, what I want to emphasize to you is that we only close out revenues, expenses, and our drawing account. The remaining accounts are permanent accounts and will stay on the books and go into the new accounting period as beginning balances. Now, they didn't ask us to prepare a post-closing trial balance this time. So that was a little bit different from your first problem, but you do need to know how to do closing entries. There was also a what if analysis that went along with this problem. And quite frankly, if you don't understand the what if analysis, don't worry too much about that. I'm going to explain it to you, but don't worry about it. What I want you to concentrate on is learning how to prepare closing entries, know how to prepare your financial statements, know that the closing entries, once they're in the journal, have to be posted to the ledger. And then there's a post-closing trial balance that would be prepared from the ending balances in the ledger. And we prepared one of those in the previous problem, so they didn't ask us to do another one here. But those are the things that I think are most important. But getting to the what if analysis. In the what if analysis, what I did is I just copied the previous statement of owner's equity down here so you could see what we had done previously, the statement of owner's equity before the owner's equity had increased. So this part 3 is a what if analysis. What if the balance of Nicole Gorman capital had instead increased to 115,000 after the closing entries were posted and the withdrawals are going to remain the same? What is the amount of the net income or loss? So I just copied this statement of owner's equity down. That's what it was before. We're going to mess with it. Now we're going to mess with it a little bit. Notice here that it says the balance of the Nicole Gorman capital account. What if it had increased by 115,000? So the only thing I did here is I put my increase in owner's equity to be 115,000. I just copied this amount that was given down here. I left the beginning balance the same. Notice it's the same as it was before. I noticed my withdrawal. I left my withdrawals the same. Notice they're the same as before. But what they're trying to get you to do is to see what would happen to the net income. So if you had had 115,000 as an increase in owner's equity, if you add that 115,000 to the withdrawals, that will tell you how you can arrive at your net income for the year. So the net income amount is 135,000 if there was an increase in owner's equity of 115,000 and your withdrawals and your beginning owner's equity stayed the same as they were before. And so all they wanted was to show the effect of what would happen to the net income. So my net income would have ended up being more than it was up here, which would have affected the ending owner's equity because these two are combined just like always. So that's all I want to share with you today. I'm going to stop sharing this screen with you and we'll see you next time. Bye-bye.